everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, economic and market research analyst for TMX Verify. Today we're going to talk about a couple of ways to look at market valuation. The conventional trailing 12 months price to earnings ratio, aka the TTM PE ratio, and the more reliable PE10 ratio. The TTM PE is what you'll see in most places, but we'll show you why a different approach, the PE10, gives us a much better long-term perspective. First, let's look at the conventional TTM PE ratio. It's calculated by taking the current price of the S&P 500 and dividing it by the earnings from the past 12 months. This table here shows the trailing 12-month earnings, which are a combination of reported numbers and S&P's own estimates for the upcoming quarters. You can see the earnings for July 2025 were at $226.98. At the end of July, the trailing 12-month PE ratio was at 27.7. However, the trailing 12-month PE ratio has a major flaw. Its historical average is around 16, but it can be very misleading during periods of market stress. For example, during the 2008-2009 financial crisis, the ratio shot up to triple digits because earnings collapsed faster than prices. The same thing happened during the tech bubble and the 2020 pandemic, where the PE ratio hit 46.7 and 39.3 respectively. This chart here clearly shows how volatile and unreliable the TTM PE ratio can be as a consistent indicator of market value. This is where the PE10 ratio comes in. This concept was pioneered by Benjamin Graham and David Dodd, who realized that temporary business cycle fluctuations made the conventional PE ratio illogical. So, they proposed using a multi-year average of earnings to smooth things out. More recently, Professor Robert Shiller has popularized the use of a 10-year average of inflation-adjusted earnings. We call this the PE10 ratio. This chart shows the history of the PE10 ratio all the way back to the 1870s. At the end of July, the PE10 ratio was at 37.4. You can see here that the PE10 ratio tracks the real inflation-adjusted price of the S&P composite incredibly well. Since 1881, the correlation is nearly perfect. The long-term average for the PE10 is 17.6, but as you can see, it has had some dramatic swings. Our current ratio of 37.4 is 69% above its long-term trend line, giving us a much clearer picture of where the market stands today. To understand the current PE10 ratio of 37.4, we need to put it into historical context. We can use both quintile and percentile analysis. The current ratio is in the highest quintile, which suggests the market is highly overvalued. Looking at it by percentile, the current ratio is approximately at the 98th percentile, meaning that only about 2% of the time in its history has the PE10 ratio been higher than it is today. Now let's visualize this using the arithmetic mean. The historic average PE10 is 17.6. This chart shows the ratio's deviation from that average. For example, the all-time high of 44.2 from 1999 was 151% above the average. The all-time low of 4.8 in 1920 was 73% below the average. As of July 2025, the PE10 of 37.4 is 112% above the historic arithmetic mean. Now finally, let's look at the PE10 ratio relative to its geometric mean for a slightly different perspective. Based on the geometric mean, the all-time high was 174% above the average, and the all-time low was 70% below. As of July 2025, the PE10 ratio is 131% above its historic geometric mean. Our last few charts highlight just how extended the current market valuation is compared to its long-term history. Thank you for tuning in. I hope this has given you a clearer understanding of market valuation and the importance of using a long-term, cyclically adjusted metric like the PE10 ratio. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.